Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is Gary Wagner, the editor of goldforecast.com. Gary, welcome back.
Thanks so much for having me.
So,
Pleasure.
Gary, thanks for joining us. I'm going to put on the screen the CPI chart because I know this is something you're really hot about these days. You know, the criticism of the Fed is they were really slow to raise interest rates as inflation was getting out of control. And you can see here on the graph, I'll highlight it here. As we were going all through 2021, it was getting into the 5% range and then just kept going. And they were sort of trying to pretend it was transitory back then. You know, what's the key mistake they made back then and that they continue to make right now, in your opinion?
Well, you have to start with a global pandemic that led to economies across the world shutting down. That's never happened in my time. I don't believe it's ever happened where we had just a complete, utter stopping of global industry. And so when that happened, that was a true black swan event. You can't blame a government or anyone for that. And if you did, it doesn't matter. But it led to a very, very deep recession. And during that recession, the government started adding, the US government, tons of trillions of dollars in stimulus, increasing our national debt. But as we got out of it and things began to normalize in 2021, that was the beginning of it. We started the year with inflation at about 1.4%, very, very much under their 2% target. But it slowly ratcheted up month by month. Went to 3%, then 4%. About the middle of the year, it was already at, I believe, about 5%, 6% in November. And by the end of the year, if I'm correct, it was somewhere around 7%. And yet, during the entire time in 2021, the Federal Reserve, when they could have really squashed inflation right then and there by some small incremental rates, realized we had interest rates between 0 and 25 basis points. In other words, interest rates set by the Fed funds rate was at absolute zero. They just by raising it a couple of percent, they could have had an impact. But as you correctly pointed out, their assumption was they didn't need to act because inflation was transitory. It would work itself out through the system as the supply chain bottlenecks kind of eased. And that was a fundamental mistake, getting that wrong. That assumption was so incorrect that it led us to where we are now, in which we've saw inflation spiral to the highest level in about 41 years. It's still rather high. I mean, it peaked out at 9.5% vis-a-vis the CPI and is now down to the low eights, I believe 8.1, 8.3, somewhere in that area. But the Fed follows the core CPI and the PCE. And last month's report showed that there was an uptick in inflationary pressures in core inflation. And so they've been extremely aggressive. We've had a series of rate hikes, 75 basis points each. They have raised rates from March of 2022 to the last meeting at every single FOMC meeting. There's two left, November and December. There's a 97% or 97 or 98% probability that they'll raise rates by another 75 basis points. This, according to the CME's FedWatch tool, and about a 70% probability that they'll follow that in December with another 75 basis point rate hike. If they do, that takes Fed funds rates to about 4.5%. And that's where it gets tricky, because at 4.5%, it increases the cost of just handling our national debt. The interest payments on those become excessively high. And so it's just not sustainable. And that's the problem we have. The Fed didn't react in 2021 when they needed to. They painted themselves into a corner. And once they did that, they were playing catch up and they were behind the eight ball.
So, Gary, you said in a recent video that it's basically blood in the streets with gold and silver. What do you mean by this? Don't scare us too much.
Well, what I mean by that is it's an adage that comes from professional traders that when stocks are under pressure and the public is selling, blood is in the streets. And that's when the professional trader buys. And so what I'm suggesting is we have seen gold and silver under tremendous pressure. Gold more than silver, because silver had some trouble really getting back into even the $30 range was the high that came in recently over the last couple of years. But consider this, we had gold at $2,078, the 10 off of the record high and the high of the year in March. The Federal Reserve began to raise rates. We hit a low in gold of $1,621 recently within the last month. That's a tremendous decline in terms of where gold prices have gone. And so you haven't had this opportunity to be able to buy gold at this level or silver under 19 for quite some time. And my contention is you want to be accumulating gold and silver when the public is selling. When they're bearish is when you want to be buying, because that's how the professionals over time have made money. So you buy when there's blood in the streets. And right now, when you look at the decline of gold specifically, and to a lesser extent silver, this is an opportunity to buy because everybody is so bearish. Now, could it go lower? I believe it possibly will, especially if they implement another set of rate hikes of a full 1.5%. You just dollar cost average, because people that are buying gold or silver, physical I'm talking about, are accumulating it for the long term. So if it's sitting at 1860, which is where it's at, and you buy now and then it goes to 18, just leave capital to buy more, because it's not going to stay that low forever. That's my belief.
Yeah. You know, with everything going on in the world, and we're seeing inventories in the COMEX just dropping dramatically for gold and silver. The registered category of silver is just falling off a cliff, it seems like. And that's something we watched really closely on the Reddit community for Wall Street Silver, is just people seem to be pulling these hard metals, commodities, not just gold and silver, a lot of other commodities. Platinum seems to be disappearing dramatically too. People are worried, and you're starting to see a lot more gold just flow east, gold and silver, to China and India. They seem to be taking advantage of these low prices that we're seeing in the West and just draining our vaults here and moving them to China and India.
And Russia.
Yeah.
Those three countries have been accumulating vast amounts of precious metals. Of course, in the case of palladium and platinum, a large percentage is actually mined in Russia. But in terms of gold, they have been net buyers of gold for a couple of reasons, which I don't think we have time to go into. But the bottom line is, you're absolutely correct. You've got those three countries physically are buying as much physical gold and silver and other precious metals as they can. Some people talk about the fact that they have this grand plan to go back on some sort of modified gold standard. Whether that comes into fruition or not is not the case. The case is they are accumulating, and they're accumulating at a rapid pace.
Yeah, it seems like every other central bank on the planet seems to be buying, except for the European Union and the United States and Canada. Of course, Canada got rid of all their gold and their brilliance.
Idiots.
But it's just, I find it very bizarre that the Eastern, the Asian cultures, China seems to have this affinity for gold, and India seems to have this huge affinity for silver. They're using our, if there is suppression in the markets that's holding down the prices, they're taking advantage of it, and they're buying it as cheap as they can to accumulate. It seems like everyone's getting ready for a monetary new system, or whether that's a BRICS commodity-backed currency or something else, or just a whole new Bretton Woods system, monetary system. I don't know, but it seems like they're preparing for it and we're not. And is that a huge mistake we're making?
Oh, absolutely. I mean, I think about the fact that we read in the newspaper lately, dollar's been coming down, but how strong the US dollar is.
Yeah.
And it's such a misnomer on the surface. Yes, it's stronger than the basket of currencies that it's against. The analogy I like to use is, if you're looking at a basket filled with apples and most of them are rotten, you want to pick the least rotten apple out of that basket, you're going to grab the dollar. In other words, it's been a race to zero as all of these fiat currencies continue to devalue themselves because they're printing more money. They're getting themselves into larger and larger amounts of debt. And it really is an experiment. The experiment began, as you said, Bretton Woods. It really began in 33 when Roosevelt collected all the gold from the citizens. It was sitting at $20 per ounce for gold and $1 per ounce for silver for a lot of years. And then what did he do? He confiscated all the gold, melted it, put it into Fort Knox. It's questionable what's still there, but at that point, he waited a year and a half and he raised the price of gold from $20 to $35 an ounce.
Mhm.
And so the fact of the matter is that while we say the dollar is strong, what cost me $100 last year cost me $108 this year. And I question those numbers because if you look at the cost of food, it's gone through the roof. And
Yeah.
so we have less and less buying power, whether you're dealing with a Canadian dollar, the US dollar, whether it's a euro dollar. All of these currencies are getting weaker. They are being diluted as the printing presses are running. And as these presses are running, we know that historically speaking, there's never been a country that has been able to start printing money and not collapsed over time. It
Mhm.
happened in Rome, it happened in China, and now we're making this new experiment since we went off of the gold standard, and we don't know the outcome of that, except to know that it's not going to be pretty if they don't do something about it. And that's why you have so many people that are truly interested in gold and silver as a hard asset.
Mhm.
Yeah.
Over time, these two metals have always had an intrinsic value. And
Yeah.
I believe that they always will. You know, now you've got cryptocurrencies coming into the scene, but that's not a hard asset.
Yeah.
I think blockchain technology is a beautiful thing. It will be implemented across the board in multiple platforms, but inevitably currencies will go digital. Not crypto, but digital.
Right.
There, you know, I don't know if it's 10 or
Effectively,
20
they
years,
already
but-
are. I mean, most people never really touch cash anymore. It's everything's on a credit card or wire transfer or Venmo or
Correct.
you know, we are. I don't know how much different a digital currency is compared to what we're doing right now. It's right now, it's everything's digital, and I still have a cash option, but it's like I don't usually carry any cash. We're already digital.
Mhm.
So and I've seen that argument made was how much difference, whatever. It's getting off topic, but you see where I'm going with that. But I know there's something else you're watching for coming up on October 27th. And that's
Yeah.
something that the audience should be paying attention to. The third quarter GDP numbers coming out. And as everyone knows, we've had 2 quarters of negative growth so far, and they've now redefined the definition of recession. And it no longer means 2 quarters in a row of negative growth, but we're about a week and a half away from, is it 3 quarters in a row? And I
Right.
guarantee you they're going to massage these numbers like anything possible to try to make it say at least 0.1 growth or higher,
For
just so
sure.
it's not 3 quarters in a row. What are you watching for in the next GDP report?
Well, there's obviously, if interest rates have been going up, we're getting an economic contraction, which is what the Federal Reserve is looking to accomplish. That's their goal. And economic contraction, by definition, is what causes a recession. It's a declining GDP. Now, the fact that they've changed the definition, I actually was unaware of it. That to me is simply cutting a masterpiece of a picture to fit a $2 frame. You don't change the definition because it doesn't match what's going on in real life.
Mhm.
You deal with the facts accordingly. But on the 27th, we'll get the actual numbers of the third quarter GDP, but more importantly, we'll get the numbers of national debt. According to the World Clock national debt, and we all know the link to go there, we look at it and get amazed at how that continues to grow. We're at about $31 trillion in the US. Our GDP, according to that source, is about 25 trillion. So our debt outweighs our GDP. That's not a good thing. But more importantly, as interest rates go higher, if they do go to 5%, it is extremely expensive to service just the interest payments alone on our national debt. And what happens when that gets so out of balance that Yellen's going, well, how are we going to pay our bills? Because as Secretary of the Treasury, that's her responsibility. And she's been shouting about that for months and trying to give the public some kind of warning. We need to change the way we structure what we spend and what we take in. And that's the basic problem also, is that unlike a family or corporation, we cannot spend more than we have. If we do, we've got to borrow at a high price and then we have to pay it back, but we can't print more money. The government can. And that's why fiat currencies have been devalued year in and year out over the last 20 years tremendously. And so my concern right now is that their single focus right now, the Federal Reserve, is to reduce inflation. The only way to do that is to get close to matching the level of inflation and interest rates. Now, if you go with the PCE or the core CPI, that's still sitting over 6%. That's triple what their target is, which is 2%. So they've got to raise rates at least to 5% to have a really pronounced effect on inflation and bring it down. And they know that that is not sustainable. You can't keep it there for any length of time without it having detrimental effects on our government to pay our obligations. So what happens? This is what I lose sleep about at night. What happens if they raise rates to 5% and in fact inflation remains persistent? Because regardless of how high they raise interest rates, we still have to eat, even though that's not in the core. That's what we're faced with, is food and energy costs. They've remained elevated and elevated for a long time. What happens if the Fed raises rates to 5% and inflation doesn't really have a sizable downtick? It goes to 5% or 4.5%. That's well above their target of 2%. And they can't keep raising the interest rates because of the effect they have, and they can't sustain that. In other words, they're going to be pressured to put a pause button or to lower Fed funds rate because it's going to break the back of the government. And so what happens if, and whether this happens or not, no one knows, but what happens if they raise interest rates to a level of about 5%, but inflation remains entrenched? Then where do they go?
Yeah. Well, I mean, if they do the 2 more rate hikes, like you suggested, that's likely, which I agree with, and we get to 4.5%, the housing market's already come to a complete standstill. I mean, yeah, it already has. I've seen the data. People who are the number of visits to open houses has just collapsed completely. It's just a matter of time before the pricing actually changes also to catch up with that. It just seems inevitable that something's about to break, and 2 more rate hikes from the Fed might be enough to push it over by December. But we're going to have to, go through the valley of death to get to the other side and see where things lay at that point. And I think what a lot of as Wall Street Silver, we're silver and gold investors and the mining stocks and all that stuff. Everyone is just waiting to see when's the Fed going to pause. And I think you're right. By December, 2 more rate hikes, we're going to see that type of collapse happening where everything's just, the bond market's freezing up. It's almost impossible to finance anything anymore. I've talked with some CEOs saying it's like 18% to do anything these days. For business loans, no one's out there financing anything. Housing market's stopping. At some point, this is broken, and the Fed has to stop. And maybe that's December, 2 more rate hikes, and then they hint that, all right, we're done now. We're going to pause and observe, and that doesn't mean pivot back to cheap money. But I think what's likely to happen, and tell me if you think I'm right or not, we might have a pause, perhaps in December after 2 more rate hikes, where they let it digest, let's say. Is that a fair
That's a very fair assessment. There is intrinsically a lag time between raising interest rates and how that affects the economy. And that lag time is a couple of months. So I believe, as you've just said, that they'll raise it another 1.5%, take it to 4.5%, and put it on pause and see what the effect is in January, February, maybe March. And then in March, they will either begin to lower rates or they'll at least keep them where they're at. But the thing is, even at 4%, that's not sustainable for a long period of time.
Yeah.
And your point on mortgages is eloquent, and it's dead on correct, because what happens is right now you've got what the 30 years are at about 4%. You can't, if you have excellent credit, you can't get a 30-year mortgage under 6 or 7%. And so that prices people out of properties that they were able to buy a year ago.
Yeah.
And it takes a lot of people where they don't qualify at all to be able to get a mortgage. And that's what's cracking the housing market. And that's already happening. Yes.
Yeah. And the longer we stay at that 4-5% interest rate, the more debt from the federal government has to roll over and be financed. And so the interest on the debt, you know, we paid $600 billion a year in interest last year. I've seen estimates that's going to be $1 trillion to $1.5 trillion just to cover the interest on our debt, as more and more of our debt has to be refinanced at these new higher rates. And it starts swallowing up the whole budget deficit, all the tax revenue. I mean, I've seen numbers where we could be paying 35 to 40% of all tax revenue just to service the interest on our government debt within the next 2 or 3 years. And I mean, stuff starts breaking at that point. I mean, permanently. So anyways, but Gary, thank you so much for joining us. We really appreciate it. The audience really values your opinion on these matters, and we'll talk to you again in the future.
Thanks so much for having me. It was great to be here, and have a great day. And let's see what happens over the next couple of months.